So, you're comfortable with stocks and options, but futures, they feel like a whole different animal, right? Well, you're in the right place. We're about to decode the core mechanics, no hype, no fluff, just how these powerful tools actually work under the hood. Let's dive in.
Here's our game plan. We're going to start with the single biggest mental shift you need to make. Then we'll build on that, talking about sizing, strategy, and what happens when a contract gets old. By the end of this, you'll have a really solid framework.
All right, let's get into it. This first idea is everything. I mean it. If you get this, the rest of futures trading will just click into place. When you buy a stock, you own a thing, a small piece of a company. It's an asset. A futures contract? Totally different. It's not ownership, it's an obligation. Think of it like a legally binding handshake to buy or sell something at a specific price on a date down the road. You're agreeing to a future deal. Now, because these are standardized by the exchange, it means all the key details are already set in stone. The quantity, the quality, the when, and the where. The only thing left for traders to fight over is the price. And that standardization is exactly what makes these markets so deep and liquid. So every contract has its own DNA, and these 4 specs are the key genes. The multiplier and the tick tell you how much money each little price move is worth. The expiry and settlement type tell you when its life is over and how the final score is settled. This is your cheat sheet for figuring out size and risk. Okay, so we've got the contract's blueprint. Now let's look at its financial engine. This is where the money comes in, how we value a position, the incredible power of leverage, and this really unique daily profit and loss cycle. The first bit of math you need to know is notional value. It's super simple, just the price of the contract times its multiplier. This number is huge because it represents the total value of the stuff you're actually controlling with just one contract, and that's where leverage really comes from.
So let's make that real. A single micro E-mini S&P 500 contract, we call it MES, at this price point lets you control over $7,000 worth of the S&P 500. Just think about that. It's like controlling a small chunk of an ETF, but with way less cash out of your pocket.
But, and you really got to get this, that huge notional value is not what you pay. You are not putting up $7,000. Nope. Instead, you just post a good faith deposit. And that deposit is called margin. You can think of it as a performance bond. You post an initial margin to get into the trade. Then, if the trade moves against you, you just have to make sure your account stays above a lower level, the maintenance margin. It's basically collateral, ensuring you can make good on your daily promises. Okay, this right here, this is probably the biggest mechanical difference from stocks every single day. The exchange literally settles up with you in cash. If you made money, cash goes into your account. If you lost money, cash comes out. These aren't just paper gains and losses, this is real money moving around every day. The fallout from this is massive. Because your P&L is realized daily, you can't just let a huge loss sit there and get bigger and bigger. If a loss drives your account below that maintenance margin level, boom, you get a margin call. You've got to add more cash or get out of the trade. It's a built-in risk system that forces you to pay attention. So with all these unique rules, you might be asking, why bother? We've covered the how, so let's hit the why. It really boils down to a few major strategic advantages. First, capital efficiency. That's just a fancy way of saying leverage lets you control a big position with a small amount of capital. Second, they're an incredibly clean tool for hedging your stock portfolio. Third, going short is just as easy as going long. No special rules, no borrowing shares. And finally, news can break any time, and with near 24-hour market access, you can actually react to it. But a quick warning on that 24-hour access, it's not all created equal. The market really has a heartbeat. Liquidity, how easy it is to trade, spikes when the major global sessions like Asia, Europe, and the US overlap. Knowing when those high traffic hours are is pretty darn important. Okay, unlike a stock which can, theoretically last forever, a futures contract has a limited lifespan. It expires. So what happens when a contract gets close to its expiration date? This is a super critical part of managing a futures trade. You'll notice that different contract months, say June versus September, often have different prices. That relationship between all the different contract months is called the term structure. Sometimes future months are pricier, sometimes they're cheaper. For now, just know that this price curve exists. So here's the bottom line. If you want to keep your exposure to a market past the current contract's expiry date, you have to do something. You have to actively roll your position.
And that just means closing out your trade in the soon-to-expire contract and opening up the same trade in the next month's contract. Here's what that end-of-life process looks like. The last trading day is pretty self-explanatory. But for contracts on physical stuff like corn or oil, the date you really need to watch is first notice day. This is when the delivery window opens. The big takeaway for most traders is simple. If you don't want a truckload of soybeans showing up at your house, you need to be out of your position well before first notice day. And I really can't stress this enough. For any of those physically deliverable products, first notice day is a hard deadline. It is not a friendly suggestion. Your broker will have rules about this, so make sure you know what they are. Okay, for all of you who live and breathe options, there's a really important connection here. Let's take a second and connect these two worlds. See, many of the world's most liquid options aren't on stocks. They're on futures contracts. And when an option on a future gets exercised or assigned, you don't get the underlying thing itself. What you get instead is a long or short position in the underlying futures contract. This just opens up a massive strategy playbook. You can get directional by buying a future, but then protect your downside with a put option. Or you can build strategies for range-bound markets that generate income, like an iron condor, all using the capital efficiency that futures provide. All right, before you ever place a trade, here is a practical checklist. Know when the market's hot, the active liquidity window. Understand the contract's DNA, its multiplier, and tick value. Check the margin requirements. And please know the expiry calendar and have a roll plan. And of course, define your size and your risk limits before you even get in. And one final piece of advice. With the kind of leverage available in futures, position sizing isn't just a detail. It's the absolute heart of managing your risk. Size it like you mean it.
And that brings us to our last and probably most important point. Let's be crystal clear about the risks. Futures are highly leveraged. That means losses can, and sometimes do, exceed your initial deposit. Margin calls can happen fast and force you out of a trade at the worst possible time. And if you're touching physical contracts, you must understand the delivery risk. So be informed, be prepared, and treat these markets with the respect they deserve.